Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and typically joining me would be Mr. Michael Becker, but he is on another due diligence assignment and is out of the area. So you just have me today. So we appreciate you spending some time with us. If you think that we bring some great ideas to you, if you're thinking about getting the multifamily, please leave us a five-star review for iTunes. On the Old Capital Podcast on iTunes. We certainly would appreciate it. And maybe some comments if you think that we do a good job just trying to educate you about some of the things that we think are important in multifamily ownership and financing and due diligence and some of the things that why people buy multifamily properties. So again, don't forget October 20th and 21st, we have the Old Capital Multifamily Conference. This year it's going to be virtual. The multifamily conference has always been in person because of crazy times. We're going to be virtual, but I think you're really going to enjoy this one. The theme of this conference this year is going to be Keep Multifamily Great. Keep Multifamily Great. And so we're going to have kind of leading authorities about what's going on in multifamily. You know, there's a lot of educational programs out there and mentoring programs out there that kind of talk about why you should get into it. We kind of go to the next level. We already believe that you think you should be into it. So now we're going to try to educate you some of the reasons why you should be into it and some of the things that you should be thinking about it before you put your first or your next dollar into multifamily. So we're going to have a couple of economists. We're going to have people that have been general partners, some of the things that they learned that they can share with you. Not just people that have done one deal, but maybe these people have done 25 deals and been doing the business for 35 or 40 years. Some great knowledge base. So we want you to join us on October 20th and 21st on the virtual multifamily conference for Old Capital. Go to the Old Capital Conference, and then sign up RSVP to join us on that conference. I think you'll learn a ton. And so Old Capital Lending, you know, we've been around for a long period of time, and many people ask us, Paul, when do you ever talk about real estate lending? You talk about with putting transactions together, you talk to general partners, you talk to limited partners, you talk with a lot of the people surrounding multifamily. How about talking a little bit about lending? Just give us an update. So I thought we'd do that for this episode. And so we brought in one of our best underwriters out there, and his name is Darryl. And Darryl is a Freddie Mac Small Balance Specialist, a Freddie Mac Small Balance Specialist. And so today we're going to be in the podcast where we can be talking about Apartment Lending 101. And so when you are thinking about buying an apartment building, remember that 75 to 80% of the money comes from your best and your brightest partner, and that is the bank or the lender in the transaction. You go out, find the property, you bring in the equity, we'll bring in the debt to the deal. So there's different ways of structuring the debt. A lot of times if you are a brand new apartment owner, you may go down to your local lender, your local balance sheet, your banker, and ask them for a loan. And those typically are loans that are based on your own personal liquidity, your W-2s, your paycheck stubs. But when you start to do larger transactions over $1 million, $2 million, $3 million, $4 million, you don't want to have a lot of contingent liabilities. You don't want to have a lot of things on your balance sheet. To go bigger and go larger, you have to do some non-recourse lending. And that is kind of our topic today, is we're going to be talking about the Freddie Mac Small Balance Program. Last time we had someone in to kind of talk a little bit more about that. It was probably about 2 years ago. So I thought we'd just kind of give you an update about what's going on in the Freddie Mac Small Balance Lending. So Darryl, thanks for being on the podcast. We certainly do appreciate it. Let's kind of walk into the Freddie Mac Small Balance Loan. And again, tell us a little bit about the genesis of the loan program, how long it's been around, what it's good for, and let's talk with somebody that maybe has never bought a multifamily property and kind of walk through it in their eyes and what they should know.
Thanks, Paul. So to speak to the Freddie Mac Small Balance program, Freddie actually created this program in October of 2014. And the reason they did that is they really saw a need, for the program, financing multifamily properties with loan amounts in that 1 to 7.5 million range, which they deem as small balance, because there really wasn't any other program, from an agency standpoint that was servicing that side of the market. So when they rolled out the program in October of 2014, they were really hopeful that they would do about $750 million in loans in 2015. It turned out they ended up closing over $2.1 billion in 2015. So the response far exceeded their expectations. In the subsequent years, they financed as much as $5, $6, $7 billion a year. So there's a number of different reasons why the program went over so well in the market, but primarily there was just a need outside of your typical financing with a local or regional bank. So it's definitely been well received in the market.
Yeah, it's definitely a great product to have, a great tool in your toolbox if you are an apartment owner. So let's kind of go into the weeds a little bit. So the Freddie Mac Small Balance is for loans really between $1 million up to about $6 million in most markets. So $1 million loan amounts up to $6 million. And then in some of their top markets or standard markets, and if it's less than 100 doors, they can go up to $7.5 million. Again, these are loan amounts. And so if you are thinking about buying a property, let's say it's a $1.2 or $1.3 million, and you're looking for maybe up to 80% leverage, and your loan amount is greater than $1 million, then it's going to help or qualify for that. So, Darryl, let's kind of go through what max LTVs are in top markets, and what does top markets really mean? What does that mean for somebody that's never done multifamily before?
Sure. So, one of the first major changes that Freddie made to the program after rolling it out was May of 2015. They actually broke their markets into tiers. And they actually broke them into tiers by way of census data, because census data actually identifies the number of renters in a general area or county. So relative to top markets or standard markets, that's where a renter population is in excess of 60,000. So Freddie deems any county or MSA that has a 60,000 renter population or greater to be a standard market or a top market. 30 to 60,000 Freddie deems as a small market, and below 30,000 renter population is a very small market. So if you're looking at a market such as Dallas, Houston, San Antonio, those are obviously larger markets, and Freddie deems those as a standard market. Out of those larger markets, Freddie's really identified a handful of markets, about 10 or 12, that they consider to be a top market. What they consider the best of the best, so to speak. In Texas, Dallas County is a top market, and then you get into the larger MSAs around the country, such as Los Angeles, San Francisco, New York, Miami, things of that nature. So, those are the markets, the top markets that really Freddie gets their most aggressive on relative to lending. So in any decent sized market or standard sized market, Freddie will generally go up to an 80% loan to value, and they will underwrite at about a 1.25 debt service cover, or DSCR. In those top markets, Freddie actually gets a little bit more aggressive. They're still at 80% LTV, but they'll actually go down as low as 1.20 debt service coverage. So that's where they get aggressive. Actually, and their pricing, their rates get a little bit more aggressive as well when you're in that top market. But Freddie overall is extremely competitive regardless of whether it's a top market, standard market, or even a small market. So that's, the larger markets or those that generally have a larger rental population or a large MSA.
So that's maybe one of the large benefits of the Freddie Mac Small Balance program, is that you can go into, say, some of these smaller markets. And I'm talking about, very small markets, maybe like Abilene, Texas, or Panama City, Florida, or Napa, California, because they have typically less than 30,000 in population of renters in that area. So that's a very small market, but you still can get up to, say, on an acquisition, up to 75 leverage in these deals. So
correct.
So that competes very well with the banks. So give me, on your top list, Darryl, of the top, say 4 or 5 things, why somebody really should consider, besides the higher leverage, why should somebody consider, if they're getting into multifamily, to use the Freddie Mac Small Balance?
Sure. Well, first and foremost, all of the Freddie Mac Small Balance program, all of the programs are non-recourse to the borrower. So there's no personal liability should, something negative happen relative to the loan. Now, a lot of borrowers say, well, it's no big deal. I pay my debts, and that's great. But, at the same time, when you're applying for multiple loans down the road, the more non-recourse debt you show on your balance sheet, on your schedule of real estate owned, the easier it is to get subsequent financing down the road. In addition to that, there is no limit for the amount or the number of properties that you can finance with Freddie Mac. Quite frankly, they love a repeat borrower. So unlike a bank where oftentimes you can cap out if you've borrowed, X amount of dollars with a local bank, that does not apply with Freddie Mac. So, we have many borrowers who own 10, 20, 30, 40 different properties, all financed under, Freddie Mac debt. So that certainly is a big benefit. Certainly the non-recourse aspect of the loan is a big benefit. All of the agency loans are assumable, by the way. And unlike the bank loans, typically there's no depository relationship required for them to give you a loan. We don't collect tax returns on the borrowers. We're not looking through all of the other properties, that you own, or your global debt, your global cash flow. It's really all about this specific property that is being financed. So, those things are really relative to the borrower, the non-recourse fact, the no tax returns, the no, bank relationship required, all go into making Freddie Mac really the most popular small balance program in the market.
So we're at the end of September here. So rates would, on that type of program that offers all these benefits, what's that, 7-8%? Is that where rates are right now for the Freddie Mac Small Balance?
No, under the Freddie Mac Small Balance, one of the great benefits of the Small Balance program is they're very aggressive relative to rate. Right now, we're financing most all of the properties in the mid-3s rate-wise.
I was joking around about 7 or 8%. So, when you're in the mid-3s and you can lock that loan up to 10 years, and you could probably do a 20-year term. Can you tell us a little bit more about, these fixed rates again? Talk a little bit about the different types of terms, because when you buy a property, you want to make sure that you understand how you're going to exit eventually down the road when you want to sell it, and what the cost is on the sale to get out of that loan, because most transactions on the commercial side have a significant prepayment penalty. So if you can kind of match your prepayment penalty and have that go away versus the time you want to sell that property or refinance it or do something else with the deal, you've got to match that pretty carefully. So Darryl, tell us a little bit about terms and then also the prepayment penalties.
Sure. Well, one of the good things about the Freddie Mac loan is first off, all of the loans are amortized over a 30-year period. But you can lock into your rate for 5, 7, or 10 years. And by the way, you're locking into that rate at application, which is a huge benefit. So regardless of whether rates move up or down, you know what rate you're going to get at closing from the day you sign that application. But it's great from the standpoint that you can structure your loan, to be for 5 years, to be for 7 years, or 10 years, and terms actually even go up to 20 years. That way you can kind of match your fixed rate on the loan for, along with your exit strategy on the property. You might be planning on buying that property and holding it for 5 years or 7 years, or I'm going to keep this property, for an extended period of time. One of the benefits of the Freddie program is you can simply, tailor your program, your rate to kind of your strategy relative to the property. So right now, because of where rates are at, we certainly see a lot more people, locking into that longer term, 10-year fixed rate to really lock into these lower rates, because we're certainly at a low point. So that's certainly one of the big benefits of the Freddie program. Like with all programs out there, really every loan program has some sort of prepayment penalty attached. The lender or the agency, the reason for the prepayment penalty, they're counting on a specific return over a specific period of time. With Freddie Mac Small Balance program, you actually have choices, relative to that program. So, for example, on the 5-year, you can do a step-down prepayment penalty, meaning, you will pay a prepayment penalty of 5% in year 1, 4% in year 2, 3%, 2%, 1%. So you can choose a step-down option, or you can choose a yield maintenance option, which has a little bit better rate as well. So with the program itself, you have options as far as how long you want to lock your rate in for, be it 5, 7, or 10 years, and how you want to structure your prepayment penalty to go along with it. So certainly those are some of the great features of the Freddie program. You have a lot of options that can come into play or give you some choices relative to your particular strategy with that particular property. When
you have a bank loan and you talk with your banker and again, he's borrowing money or bringing in money from deposits from your Aunt Nancy or your Uncle Tom or your Uncle Bill or whoever they're bringing in deposits from to lend you the money, they really don't want to give you interest only because they are kind of risk adverse. And once they give you, they want to try to reduce that balance of that loan as quickly as possible. And so they really are going to play tug of war with you when it comes to interest only. So Darryl, tell us a little bit about on the Freddie Mac Small Balance, what's Freddie Mac looking for interest only, and what can they do with the interest only? How long?
Sure. So under the Freddie program, the interest-only options are, they kind of coincide with the particular program you choose. So on the 5-year program, you can do up to 12 months of interest only. On the 7-year, you can do your first 2 years as interest only. And on the 10-year, you can do up to 3 years of interest only. Now, that's at maximum leverage of 80%. If you get, below 65% leverage or less, you can actually do full-term IO. So it's really good from a cash flow perspective, knowing that you have that option available to you to increase your cash flow on the property. We also see a lot of investors and borrowers out there who sometimes don't necessarily want to go interest only for 3 years or full term. They want it for the first year or two because they plan on, repositioning the property, putting a little bit of money back into the property and, in the early years of the loan. So it gives them that much more cash flow, to improve the property. So with agency and with Freddie Mac Small Balance in particular, probably half of the loans that we see carry interest only with it. It's definitely a popular feature. And quite frankly, there's, as you mentioned earlier, there's, most of the banks, most of the other lenders out there, that's not an option they offer. So it certainly gives you some choices in how you want to structure your loan and how you want to structure your cash flow.
And most banks don't have you have an assumability clause on it, but Freddie Mac gives you the ability to have somebody that when they're buying your property, they can assume your loan. And what's that look like? What does that mean?
Well, so another feature of the Freddie Mac Small Balance loan that most other lenders don't offer, is that assumability you mentioned. And right now in today's market, that's a really good feature to have. If you're financing a property today and you're, locking into an interest rate of, 3.4, 3.5%, when you go to sell that property down the road and you're marketing it at, hey, I've got an existing loan that's got a 3.5% rate that you can assume, that makes that property much more attractive to a buyer down the road, knowing they can assume that existing debt at that low rate, because we're at a low point in rates and more than likely, a couple of years down the road will be higher. So, it'll certainly make that property much more attractive. But the process relative to assuming the loan, the borrower comes in, the new buyer comes in, I should say, they typically pay a 1% assumption fee. They have to be underwritten to make sure they qualify from a borrower standpoint. And then it's just a matter of going through the mechanics of assuming the existing loan. So it's not a terribly difficult process, but it is something that we see a lot of folks, that are like that feature now, simply because it makes their property more marketable down the road.
How about escrows, taxes and insurance and replacement reserves into these transactions? I mean, most lenders are going to require you to put up money. It's your kind of your own internal savings account that Freddie Mac is going to hold, let's say, and making sure that the taxes and the insurance and the replacement reserves are going to be paid. What does the Freddie Mac small balance do?
So relative to Freddie Mac small balance, typically, your tax escrows are required. Historically, Freddie has not required any escrows for insurance, nor have they required any escrows for replacement reserves. We underwrite those expenses, but they're not collected historically. Now, currently, COVID related, Freddie is collecting for, insurance reserves, and they are collecting for replacement reserves if you're 50 units or 51 units or more. So if you're currently purchasing or financing a property that's 30, 40 units, no replacement reserves will be collected. More than likely, once we get past COVID, related issues, then Freddie will go back to not collecting any escrows for insurance or replacement reserves. But in general, right now, they are collecting for insurance and replacement reserves as well.
Yeah, I would imagine that that's going to go away at some period of time, but not any time soon. And if this was your money, you would probably want to do the same thing, is make sure you had enough money left over in reserves to make sure that if we did have any rental occupancy income problems in the future, that you had some money left over for a rainy day. So that is some great benefits for the property. Now, tell me a little bit, is the Freddie Mac small balance program, is that for stabilized properties or is it for value-added properties? Let's say the property needed some big rehab dollars into it. Does the Freddie Mac loan program provide that?
It does not. So typically, the Freddie program was designed for stabilized properties. So when Freddie, refers to stabilized, they're typically referring to properties that are 90% occupied or better. Now, and there's some nuances to that. So generally, if you're purchasing a property, Freddie will want to see at least, 85% physical occupancy if it's a purchase transaction. We can go as low as 85%. If it's a refinance, Freddie typically wants to see at least 90% physical occupancy. Again, if it's below 30 units, Freddie's typically happy at 85. But in general, what Freddie wants to see it's an average of your last 3 months occupancy. So if the property was 85% occupied in July, 90%, in August, and 95% in September, then you've got an average of 90%, and Freddie's comfortable with that. With that being said, typically they want to see that occupancy stable or trending upward. They really don't want to see it, trending, from, was it 95 and 90 and now it's at 85%. That gets them a little bit more uncomfortable. So generally that's what they're looking for. But relative to value add, if you've got the property, that needs some improvements, if it's leased up, that's fine, but Freddie will not finance the improvements. That's something that has to be done out of pocket. Or if you're below that 85, that 90% occupancy level, then typically, you're going to need something in the way of, bridge debt to get that property stabilized. And then you can turn around and put, permanent debt, with Freddie on the property.
So talk to me a little bit about it. I mean, we talked about all the benefits of having a Freddie Mac SBL. And the one thing that I pointed out is that they're really not going to have you put rehab in the property because they really are not. They're not going to finance rehab dollars into the loan itself. Give me 1 or 2 reasons why somebody should not get a Freddie Mac SBL loan.
There's not a lot of reasons not to go down the agency road. The benefits really they far outweigh any drawbacks in the market. I mean, Freddie designed this program to be really an easy program, a streamlined program, where it's not really a great program initially. If you're looking to buy, your first multifamily and have no, real estate experience, no investment experience, generally it's not the best avenue to start off with. Freddie generally wants to see someone who has a little bit of multifamily experience. So that's one of the drawbacks relative to the program.
Let's talk a little bit about that, because what a lot of people ask, can I get an agency loan if I don't have a multifamily experience? And so what is your comments as an underwriter about that?
So Freddie, really wants to see, someone who's had agency experience. Now, if you've had, significant experience relative to, owning, a bunch of single family rentals, for 5-6 years, maybe you're looking to go out and purchase your first multifamily property. That's something that Freddie would consider if you've got a lot of experience behind you in another avenue. And if you're buying something, what they refer to as like kind. So if you've owned a bunch of single families and you're looking to buy a 20, 30, 35 unit property, you're relatively local to the market, inside of a 100-mile radius of the subject property, that's something Freddie would consider. Or, if you own a bunch of other investment properties, in general, Freddie would certainly consider that, if you have a lot of experience behind you. Generally, where there's not much of a path forward is if you have, no investment experience, no real estate experience, whatsoever, is where Freddie really tends to get very, very conservative. So ideally, in a perfect world, Freddie would like to see that someone owns at least a couple of multifamily properties and have owned them for the last at least 2 years or more. Generally, that's something that Freddie is fairly comfortable with. If it's your only property and you're looking to refinance it, ideally, Freddie would like to see that you've owned that property for 4 or 5 years. Yeah, what we see a lot of times is for that new property owner, generally they will partner up with someone who has the experience that Freddie's looking for, and generally with a co-borrower, and typically that works out very well.
That's certainly true. So if you do not have multifamily experience and you're trying to put together a syndication, look for somebody that can join you in the partnership that's going to be part of your managing member group that has multifamily experience, has apartment experience, perhaps local to the area. If you're buying a property, Freddie Mac pretty much wants you to be within 100 miles of the subject property. They don't want you to live in New Jersey and now you want to get your first deal that's in Los Angeles or in Dallas. What's our thinking about that on long distance ownership groups?
That's a great point. What Freddie is not comfortable with is somebody looking to purchase their first multifamily property, outside of where they reside. As you mentioned, 100-mile radius is definitely something that Freddie has really gravitated to on buying that first property. Ideally, they want you to be within that 100-mile radius. Typically, they're going to require that you engage professional third-party management as well. But we've seen a number of instances where we have borrowers coming from California to buy in Texas who are looking for a higher return, a yield. And that's something that Freddie's not really comfortable with, somebody who's looking to buy their first multifamily asset, outside of that radius or outside of the state. And the reason being is Freddie can really trace back, any loans they've had problems with. A lot of times it's due to absentee sponsorship. So, there's really no substitute in Freddie's mind for having those boots on the ground, within a certain proximity to the property, so you can kind of go out and check on it regularly. So that's something that Freddie is really keyed in on is having, if you don't have that experience or not a lot of experience, they most definitely prefer you to be relatively local to the property, and that being defined as inside of a 100-mile radius.
Talk to me a little bit about people that are foreign nationals wanting to buy properties in the United States. What's Freddie Mac's up-to-the-minute decision on those type of transactions?
Sure. So that's another one of the great things about the Freddie Mac SBL program. They absolutely will lend to foreign nationals. And what they consider to be a foreign national is someone who, does not necessarily reside here in the U.S. on a permanent basis, and someone who does not hold a green card. Freddie treats green card holders the same as a U.S. citizen. So the foreign national is someone who typically is not residing here in the U.S. on a full-time basis. So what Freddie will still lend to them. They will still lend to them under the same loan-to-values, the same debt service coverage, but there is a few more hoops that the foreign national has to jump through. First, they do want to see that particular borrower owns some investment property here in the U.S., ideally the multifamily, as we mentioned before. They do want to see that particular person has something in the way of a residence here in the U.S. when they visit, as opposed to just staying at, a hotel when they come to town. In addition to that, relative to the foreign nationals, a couple of the things that Freddie requires is that they maintain a balance here in the U.S., be it in the bank account or, maybe their Merrill Lynch stock brokerage account, at least 5% of the loan balance. Ideally, Freddie wants to see that, with the foreign nationals as well. So in addition to that, they also have to appoint someone here in the U.S. to accept service. So in other words, if Freddie had to serve papers on a particular property, they need someone identified here in the U.S., be it a CPA or a law firm or something of that nature that they can actually drop papers to locally, or I'd say locally here in the U.S. as opposed to, sending things outside of the U.S. So generally, with the foreign guarantors, Freddie will still lend to them. They will still underwrite, the same as always. They just want to make sure that they have some experience here in the U.S. They have something in the way of a residence here in the U.S., and they maintain some liquidity, here in the U.S. as well as appointing someone to accept service. So we've done a number of loans for the foreign nationals coming here, into the U.S. And it's really been nothing more complicated than what we already do, provided, that the borrower, has those 4 or 5 additional points that I just mentioned.
So let's talk some exceptions out there. There's a lot of people always think about maybe some exceptions to the rule. Again, if the loan amount is under $1 million, is that a maybe or no way?
It used to be a maybe. Now it is a hard no. Freddie simply cannot entertain any loans that are below $1 million anymore. And that's per, the FHFA, their regulator. So they simply don't have the ability to lend on anything below $1 million anymore.
Then how about student housing or military housing? What's the rules on the Freddie Mac SBL?
So originally when the SBL program was rolled out, you could have a concentration of up to 25% full-time students or, full-time military, active duty military. A couple of years into the program, Freddie actually bumped those percentages up to 50% students and 50% active military. But over the last year, they've really backed those back down to 25% and 25%. And that's especially, with the students because, right now with COVID related, obviously some of the students have gone off to school and already, classes have been canceled or at least in-person classes. So they've gotten back a little bit more conservative on the students as well as the active military.
And then sponsors or the controlling member residing greater than 100 miles away from the subject property. I think we've talked about that, but I want to make sure we drill down on that just a little bit more.
Sure. So if you have a sponsor who has plenty of multifamily experience, so we're owning 3, 4, 5, plus properties, where he resides is really not as important as it is for the person who is looking to buy their first or second multifamily property. So if you've got the experienced property owner, who has a number of properties, out there, generally Freddie will be comfortable, with that sponsor residing anywhere in the U.S. Generally, what they will require and want to see is professional third-party management, especially if that sponsor is not local to the property. It's really, when you get into the sponsors that don't have a tremendous amount of experience behind them, that they want to see them residing a little bit closer to the property. So if you own one property, maybe 2, ideally Freddie would like to see you a little bit more local to the property. But even then there's a little bit of leeway. But if it's your first property, they definitely want to see you within that 100-mile radius, unless you have the co-sponsor or co-guarantor, as mentioned a moment ago, that does have that experience and owning other properties.
And how about putting equity into these transactions? Let's just give you an example. Let's say if you're going to do a bank loan, they're going to require you to put down 20 or 25 or 30 or 35% into the deal. And that usually comes out of your pocket if you're the sponsor of the deal. What does Freddie Mac feel about, you raising a bunch of money from your limited partners, and how much money do they want the general partner or the sponsor that maybe has some experience to put into the transaction?
So, Freddie's very comfortable with syndicated deals, and we've done, I can't count how many, loans that we've done where syndication is involved. So that's definitely something that is significantly different from typical bank financing. Also, different with the bank financing as well is again, we're amortizing over 30 years. A lot of times the banks are putting a 20 or a 25-year am on the loan as well. So that certainly makes a difference relative to cash flow. As far as a percentage of ownership required, to be held by the general partner or the primary guarantor, there really is no hard and fast rule, when it comes to that. Freddie, we've financed loans, where the general sponsor has owned, 1-2%. It's kind of case by case, but Freddie, they have not put in any hard and fast rules saying the general partner should, or the general sponsor should have 5 or 10% even. So it's typically case by case.
Yeah, or 20% or 30% into the deal. So that is another advantage for a Freddie Mac non-recourse loan. Let's talk about the quality of the asset itself, because a lot of people that are kind of brand new to multifamily, they kind of buy in kind of sometimes distressed areas, older areas, economically challenged areas, and sometimes these economically challenged areas have crime on them. What's Freddie's feeling about properties that may have had a violent crime in the past, or currently have drug-related issues, or something that is going to be possibly trouble?
Well, so crime is definitely a hot button for Freddie. If you have a one-off incident at the property, and unfortunately we've seen that relative to a homicide even. So if it's a one-off incident, that's typically something that Freddie can get comfortable with, especially if you're a new sponsor coming in and purchasing the property. What Freddie doesn't want to see is a historical trend of crime, at the subject property, where there's drug-related crimes or that are constantly going on, at the subject property, where it's got a reputation in the community or in the media as being a problem property. That's something what Freddie is not comfortable with. So we've certainly seen that, but if it's a one-off and you've got a new sponsor coming in, Freddie will typically ask you, well, what's your plan relative to managing the property and managing, crime-related issues, and generally, we'll see what the sponsors, typically plan to do. We plan on putting up security cameras at the property, or, I'm giving discount for public safety or police officers to reside at the property, or a lot of times we've seen that sponsor work hand in hand, with the police departments in the community, because the police want a sponsor that's going to come in there and work with them, at the property to really clean it up, so to speak. Other things that we've seen the sponsors do and tell Freddie that they get really comfortable with is our screening process relative to tenants.
Yeah, talk to me a little bit about timing on something like this. These transactions, can't happen in a week or two. How long does it typically take to have a loan from application to actually getting the keys to the property?
So generally, from application to closing, you're looking at a range of 50 to 60 days from start to finish. That's from the day you sign the application to closing date. And generally, what we see happening is once the application is signed, immediately, third parties are engaged to go out to the property and do a site visit. And when we're talking about the third parties, we're talking about the appraiser, the property inspector. Generally, there's about a 2-week turnaround time on those reports. During that time frame, we're seeking to get all of the due diligence from the borrower relative to not only to him, the sponsor, but also relative to the property, the historical financials, things of that nature. Once we have those and we have the third parties back, we internally, re-underwrite the deal, and then we upload it to Freddie Mac for them to do a final underwrite. And typically, Freddie's turn time on a final underwrite is about 2 weeks. So typically, we're getting a commitment back from Freddie between day 45 and 50. and then generally we're closing, 4, 5, 6 days later. So roughly the timeline right now is about between 50 and 60 days, generally 55 to 60 days.
Boy, that's pretty quick to get something closed and out the door within that period of time. Now, there's typically 1% origination fee, and there's some fees that come with it. Give me an idea of what third-party fees that we would typically collect up front.
Sure. So typically up front with any Freddie loan, we're collecting a deposit for third parties, which is generally about $7,000. Typically your appraisal is going to run about $3,500. The property inspection, that being the engineer who goes out and reviews the condition of the property, generally that's about $3,000. And, then, some zoning reports, background checks, things of that nature. Generally, we're totaling out around $7,000. So that's what's collected up front. And in addition to that, Freddie, outside of a top market, generally has a 10 basis point processing fee. So we're also collecting that at the start of the process as well. So if you've got a $2 million loan, that's $2,000. So generally on that particular example, we're collecting $9,000 up front. And that is one of the benefits of the program. As you mentioned, from a timing standpoint, it is a streamlined program. It's a little bit of a cookie cutter program, if you will, which allows you to go from application to closing, in less than 2 months.
Yeah. I mean, there are a whole heck of a lot of benefits to having the Freddie Mac Small Balances, a tool in your toolbox if you are thinking about becoming a multifamily owner and operator. Just final thoughts, Darryl. Anything more to add to somebody that may be brand new to multifamily that wants to maybe think about getting into it? Freddie Mac Small Balance certainly sounds like a good way of getting it done.
Sure. Well, one of the great things about multifamily is, it's really the safest of all the asset classes in the market. There's fewer delinquencies on multifamilies. There's fewer foreclosures on multifamily than any other property type, and than retail, than office, than industrial. I mean, it's the safest of the investment classes out there. So, that's one reason why Freddie is very aggressive with their rates and underwriting. They know that this is a safe asset class. And really, one of the great things about multifamily and what's changed a little bit in multifamily over the last, 10, 15 years is, you don't have the no money down programs out there with average credit for people to buy homes anymore. So you've got, that renter population that's going to be there. And quite frankly, you've got a lot of the younger people in the market nowadays who are not looking to go out and buy, as quickly as they were in the past. So you really do have a built-in population that's looking to rent. So that's one of the things that we see. And another as well is buying the existing multifamily property out there, and especially with the Freddie Mac Small Balance. Generally, these are your kind of your Class B properties. They're not the newest ones that have come out of the ground. And with the cost of construction and the cost of land now, you simply can't build these properties anymore. So it's very difficult for somebody to come in and build a property next door, to compete with yours with the amount of rent you're charging on these type of properties. So you've got a limited supply and a tenant base that's always going to be renting out there. And that's why you have the lowest default rate and the lowest delinquency rate of any asset class in the market.
Absolutely. And so some great information that came from our specialist of the Freddie Mac Small Balance. Darryl, thank you very much for spending some time with us. Definitely have learned a few things. And I'm sure that you would be just a huge asset for somebody that we wanted to get into multifamily, that we could arrange a call. So if you are available at some period of time, and you are, because you're part of our team, we certainly do appreciate you being on. So if there's any calls that Darryl, you want to have with Darryl and kind of talk a little bit about your situation, we can arrange that. That definitely works out. So Darryl, our man at Freddie Mac Underwriting, we certainly do appreciate spending some time with us. And again, I'm Paul Peebles. Thanks for listening to the Old Capital Podcast, and we'll talk to you soon.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.